Sir Rob. Today I'm going to discuss Chapter 3 of the course Accounting Information System. Our topic is Overview of Transaction Processing. This topic will help you to learn more about the types of files in a computer-based accounting information system. We will also look at the flow of data from input through the various stages and files, and finally to the financial statement, benchmarking on the sales order process. In doing so, you will understand how an audit trail is developed. This topic will also teach you more things about the batch and real-time processing, which we discussed initially in Chapter 1. As always, in the practice of accountancy, we should remember to be professional, perform effectively and efficiently, follow standards, and document our work adequately and properly. Our topics for this discussion are 1. Transaction cycles. Discusses the expenditure, conversion, and revenue cycles which process most of the entity's financial transactions. These cycles exist in all businesses, both the profit-making and non-profit types. 2. Types of files. Explains the various types of files that one can find in a computer-based accounting information system and in any information system for that matter. These files form the basis of an audit trail in a computer-based accounting information system. The next two topics will be discussed: benchmarking on the sales order process. 3. Flow of data. Depicts how data is captured and goes from one file to another, ending in the general ledger master file that becomes the basis for the generation of financial statements. And lastly, 4. Batch and real-time processing. Looks at the various processes that edit, sort, and update master files, and also a detailed example of how a real-time process can be employed in conjunction with a batch process. And on with our first topic.
Transaction cycles. In Chapter 1, we were introduced to the transaction processing systems. As we have noted, these components of the AIS is the most costly and widely used component of the AIS. TBS applications process financial transactions which fall under one of three cycles: the expenditure cycle, the conversion cycle, or the revenue cycle. These cycles exist in all types of businesses. For instance, every business, 1. Incurs expenditures in exchange for resources. Expenditure cycle. 2. Provides value added through its products or services. Conversion cycle. And 3. Receives revenue from outside sources. Revenue cycle. A financial transaction is defined as an economic event that affects the assets and equities of the entity, is reflected in its accounts, and is measured in monetary terms. The most common financial transactions are economic exchanges with external parties. These include the sale of goods, the purchase of inventory, the discharge of financial obligations, and the receipt of cash on account from customers. Financial transactions also include certain internal events such as the depreciation of fixed assets, the application of labor, raw materials, and overhead to the production process, and the transfer of inventory from one department to another. Financial transactions are common business events that occur very regularly. For instance, thousands of transactions of a particular type, such as sales to customers, may occur daily. To deal efficiently with such volume, business firms group similar types of transactions into transaction cycles. All the financial transactions processed by the TPS falls under one of the three transaction cycles: the revenue cycle, the expenditure cycle, or the conversion cycle. Even though each cycle performs different specific tasks and supports different objectives, they share common characteristics. For example, 1. All three cycles capture financial transactions, as already mentioned. 2. Record the effects of transactions in accounting records. And 3. They provide information about transactions to users in support of their day-to-day activities. In addition, transaction cycles produce much of the raw data from which management reports and financial statements are derived. Because of their financial impact on the firm, transaction cycles command much of the accountant's professional attention. The succeeding diagram shows the relationship of these cycles and the resources flowing among them. Business activities begin with the acquisition of labor, materials, and plant, property, and equipment in exchange for cash. This is the expenditure cycle. The figure above on the slide shows the flow of cash from the organization to the various providers of these resources. Most expenditure transactions are based on a credit relationship between the trading parties. The actual disbursement of cash takes place at some point after the receipt of the goods or services. Days or even weeks may pass between these two events. Thus, from a system perspective, this transaction has two parts: a physical component, the acquisition of the goods and services, and a financial component, the cash disbursement to the suppliers. A separate subsystem of the cycle processes each component. The major subsystems of the expenditure cycle are outlined here and will be discussed in the succeeding lecture videos in great detail. Purchasing or accounts payable system. This system recognizes the need to acquire physical inventory such as raw materials and places an order with the vendor. When the goods are received, the purchase system records an event by increasing inventory and establishing an accounts payable to be paid at a later date. Cash disbursement system. When the obligation is created in the purchase system becomes due, the cash disbursement system authorizes the payment, disburses the funds to the vendor or service providers, and record the transaction by reducing the accounts payable in cash accounts. Payroll system. The payroll system collects labor usage for each employee, computes the payroll, and disburses cash, paychecks, or through bank payroll accounts of the employees. Conceptually, payroll is a specialty purchases and cash disbursement system. Because of accounting complexities associated with payroll, most firms have a system for payroll processing separate from the system that processes payments to goods and service providers. When the employees are due to be paid, the entity eventually reduces cash and increases payroll expenses. Accounts payable are also set up for the various deductions from employee salaries and wages that will eventually be remitted to Social Security entities like the BIR, the GSIS, Social Security System or SSS, or the PhilHealth, HDMF, or Pag-ibig. Some deductions are also remitted to organizations within the entity, such as union dues and other deductions authorized by the employee, such as loan amortization. These payables are liquidated in cash when the entity remits the deductions to the appropriate recipient organizations. Fixed assets system. A firm's fixed asset system processes transactions pertaining to the acquisition, maintenance, and disposal of its fixed assets. These are relatively permanent items that collectively often represent their organization's largest financial investment. Examples of fixed assets include PPEs such as land, building, furniture, machinery, and motor vehicles. Where the physical and financial phases of this kind of transaction is consummated, the entity records an increase in plant property and equipment and a decrease in cash or increase in long-term liability for financed acquisition.
The conversion cycle. The conversion cycle is composed of two major subsystems, the production and the cost accounting systems. The production system involves the planning, scheduling, and control of the physical activity through the manufacturing process. This includes determining raw material requirements, authorizing the work to be performed, and the release of materials into production, and directing the movement of the work in progress to its various stages of manufacturing. The cost accounting system monitors the flow of costs information related to production. Information this system produces is used for inventory valuation, budgeting, cost control, performance reporting, and management decisions such as make or buy decisions. We examine the basic features of these in later chapters. Manufacturing firms convert raw materials into finished products through formal conversion cycle operations. The conversion cycle is not usually formal and observable in service and retailing establishments. Nevertheless, these firms still engage in conversion cycle activities that culminate in the development of a saleable product or service. These activities include the readying of products and services for market. For example, repackaging merchandise to make them more attractive for customers, and the allocation of resources such as depreciation, building amortization, and prepaid expenses to the proper accounting period. However, unlike manufacturing firms, merchandising companies do not process these activities to formal conversion cycle subsystems. The revenue cycle. Firms sell their finished goods to customers through the revenue cycle, which involves processing cash sales and the receipt of cash following a credit sale. Revenue cycle transactions also have a physical and a financial component which are processed separately. The primary subsystems of the revenue cycle, which will also be discussed in future lecture videos, are briefly described as follows. Sales order processing system. The majority of business sales are made on credit and involve tasks such as preparing sales order, granting credit, shipping products or rendering of a service to the customer, billing the customer, and recording the transactions in the accounts, affecting accounts receivable, inventory expenses such as cost of sales and sales. Cash receipts system. For credit sales, some period of time, days or weeks passes between the point of sale and the receipt of cash. Cash receipts processing include collecting cash, depositing cash in the bank, and recording these events in the accounts, affecting accounts receivable and cash. In businesses that employ point of sale or POS systems such as groceries, supermarkets, restaurants, and most consumer goods shops, Their system are configured for cash basis transactions. The sales or service transactions are usually done in a matter of minutes, where the consumer walks in, picks the goods or avails of the service, and pay on their way out. The lag time between the sale or service and the cash receipt is very short. The system do not keep a subsidiary of accounts receivables. The accounts they need to update is only cash and inventory. The cash from cashiers and collection of accounts receivable is cycled back to the operations.
Types of files. Audit trails in computer-based systems are less observable than in traditional manual systems, but they still exist. Accounting records in computer-based systems are represented by 4 different types of digital files: master files, transaction files, reference files, and archive files. Master files. Master files are the main files that contain relatively permanent records about particular terms, particular items, or indices. For example, a customer file will contain details of a customer, such as customer ID, name, and contact address. They are usually kept for a long time and are used as an authoritative source of data when carrying out particular functions relying on computer-based information systems. Data values in master files are updated from transactions. In the example on the slide, the general ledger control accounts, the accounts receivable subsidiary, and inventory files are master files. Transaction files. Transaction files are temporary files of transaction records used to change or update data in a master file. They are files in which the data relating to business events is recorded prior to a further stage of processing and are created from source documents used for recording events or transactions. This further processing may be the use of the transaction data to update master files or the archiving of the transactions for audit purposes. After the transaction file is processed, it is usually reinitialized. That is, transactions are deleted from the file, and further transactions are then recorded in it. In the example on the slide, the sales order and error files are transaction files. Error files are rejects files are the catch bucket for transactions that the system is not able to process because of invalid data or data that may have no applicable business rules that can be applied to it. For example, a sales order may have invalid sales transactions, which product or item codes may have been defined as valid inventory codes, but which prices have not yet been defined in the item price table. When the price for such item has been updated in the item price table, then the error records may be reprocessed. Error files are regularly analyzed to determine the cause of rejection and determine what action is necessary to resolve the issue and reprocess the files. Reference files. Reference files store relatively permanent data that are used in the standards for processing transactions. They are mainly used for reference or lookup purposes. Lookup information is that information that is stored in a separate file but is required during processing. This lookup information has been a feature of one of your activities in AE111 when you're looking up data from another sheet. Another is to be updated to by main sheet. A lighter example in a point-of-sale terminal, the item code entered either manually or using a barcode reader looks up the item description and price from a reference file stored in the system. Another example of reference file is the credit table, which contains credit data related to a customer, such as credit rating and credit limit, which are referred to every time a particular customer makes the SIS order. The decision to reject or proceed with the order request may be based on whether the customer has reached the maximum credit allowed or whether the amount of that particular transaction is still covered by the credit limit assigned to the customer. Values of the reference files are updated from time to time, but not on a daily basis like the master file. The update may be to reflect new business policies such as a change in the price of an inventory item or add a new product description or price. Update to the credit reference files may be triggered by a relaxing or further restrictions in the credit policy of the entity. Archive files. Archive files are equivalent of the journals in a traditional manual system. They contain records of past transactions or historical data that are retained for future reference. These transactions form an important part of the audit trail. Archive files include journals, prior period payroll information, lists of former employees, records of accounts written off, and prior period ledgers. In our example, the sales journal is an archive file containing the current and past sales order transactions. Archives are also used to collect multiple data files together into a single file for easier portability and storage, or simply to compress files to use less storage space. Archive files often store directory structures, error detection and correction information, arbitrary comments, and sometimes used built-in encryption. In terms of portability, archive files are particularly useful in that they store file system data and metadata within the contents of a particular file. Handles can be stored on a system or sent over channels that do not support the file system in question. Only file contents. Examples include sending a directory structure or email. Files will names unsupported on the target file system due to length or characters and retaining files date and time information. Additionally, metadata facilitates transferring of high numbers of small files such as resources of, say, web pages, since a container file is transferred using a single file operation, whereas transferring many small files requires the computer to modify the file system structure for each file individually, making it considerably slower and more tedious for operator. It is best to understand the relationship of the type of files when following the flow of data in the information system from the source document to the general ledgers and ultimately to the financial statements. We will look at how the data of the sales order process flow into, through, and out of the different files affected by the sales transactions. Then, in reverse, we will also discuss how the updates to these files create a digital audit trail that is useful for the auditor in tracing transactions from the financial statements, such as the balance sheet, back to the ledger files, and finally, to the source document.
The flow of data. Let's walk through the system represented on the slide to illustrate how computer files provide an audit trail. We begin with the capture of the financial transaction. In this example, the sale is recorded manually on source documents such as a sales order form, just as in a manual system. The next step is to convert the source document to a digital format. This is done in the data input stage when the transactions are edited and encoded into the information system, usually by a sales clerk who receives the sales order, creating a digital transaction file of the sales order. In our example, we assume that the entire process is done using the batch process. The sales order forms are received by the sales clerk from business offices, where the customers file the forms and the customer care representative sends them in batches for backroom and Collingwood. It should be noted that some computer systems do not use physical source documents. Instead, transactions are captured directly on digital media. An example of this is when a customer picks grocery items from shelves in a grocery store and proceeds to the checkout counter for payment. The customer may utilize an optical character reader, or OCR, or what people know more popularly as barcode reader. The barcode reader captures the visual information on the item and converts that information into digital data, allowing the system to look up reference tables for the product description and price, which is then displayed on the cashier's monitor. In the case of online selling systems, such as that employed by Sharpie and Lazada, the sales order is keyed in by the customer himself. When he accesses the website, picks items to check out, and confirms the sales and picks out a payment option. The next step is to update the various master files at Sequential and control accounts that several sales transactions affect. During the update procedure, represented by the edit, sort, and update runs, additional editing of transactions take place. We shall discuss these 3 runs later. Some transactions may prove to be in error or invalid for such reasons as incorrect or unlocated item price, insufficient quantities on hand, or customer credit problems. In this example, the system determines the available credit for each customer from the credit file, such as when the customer uses a credit card for paying grocery items before processing the sale. Any record that are rejected for credit problems are transferred to the error file. However, in a grocery setting, if the customer have credit problems, the transaction is simply canceled and the items are returned to the grocery shelves, thus creating no error file. The remaining good transactions are used to update the master files. Only these transactions are added to the archive file that serves as the sales journal. By copying the valid transactions to the journal, the original transactions in the sales order file is not needed for audit trail purposes. This transaction file can now be erased, or scratched, or reinitialized in preparation for the next batch of sales transactions. Their audit trail. Like the paper trail, the digital audit trail allows transaction tracing. Again, an auditor attempting to evaluate the accuracy of the accounts receivable figure published in the balance sheet could do so via the following steps. Step 1. Compare the accounts receivable balance in the balance sheet with the master file accounts receivable control account balance. Step 2. Reconcile the accounts receivable control figure with the accounts receivable subsidiary account total. Step 3. Select a sample of or update entries made to accounts in the account's subsidiary ledger and trace these transactions in the sales journal archive file. And step 4, from these archives journal entries, identify specific source documents that can be pulled from their files and verified. If necessary, the auditor can confirm the accuracy and propriety of these documents by contacting the customer in question.
Batch and real-time processes. In Chapter 1, we learned some things about the batch and real-time processes and even looked at the TPS subsystems that they are most appropriate to apply. Now we will learn a lot more about these two processes, specifically at what point in the information system process they are likely to be applied. In our example of these applications, we will be benchmarking on the sales order process. However, remember that the same process apply is repeated in other subsystems. Difference between batch and real-time processes. Once again, we will look at the characteristic difference of the two processes. We already learned that in terms of transaction processing, batch processes waits for a certain condition, like time-lapsed or certain volume of transactions or a combination of both, before processing the transactions in a batch. That description is actually related to the first characteristic, which is information time frame. The amount of time lag depends on the frequency of batch processing, which can range from minutes to weeks. Payroll processing is an example of a typical batch system. The economic event, the application of employee labor, occur continuously throughout the peer period. At the end of the period, the bank transfers to all employee accounts are prepared together as a batch. In real time, each transaction is processed as they come into the system, and that affects the currency of information that users are seeing in their reports and monitors. Because records are not grouped into batches, there are no time logs between call occurring and recording. An example of real-time processing is an airline reservation system, which processes requests for services from one traveler at a time while he or she waits. Another example is, of course, the ubiquitous point-of-sale system in supermarkets, groceries, restaurants, and most consumer goods shops. The second characteristic difference is in terms of resources used by the processes. Generally, batch systems demand fewer organizational resources such as programming costs, computer time, and user training than real-time systems. For example, batch systems can use sequential files storage. Real-time systems use the direct access files that require more expensive storage devices. In practice, however, these cost differentials are disappearing because of the advances in digital storage technology. As a result, business organizations typically use the same type of technology for both batch and real-time processing. The most significant resource differentials are in the areas of system development or programming and computer operations. As batch systems are generally simpler than their real-time counterparts, they tend to have shorter development periods and are easier for programmers to maintain. On the other hand, as much as 50% of the total programming costs for real-time systems are incurred in designing the user interfaces. Real-time systems must be user-friendly, forgiving, and easy to work with. Pop-up menus, online tutorials, and technical support, and special health features require additional programming and add greatly to the cost of the system. Finally, real-time systems require dedicated processing capacity. Real-time systems must deal with transactions as they occur. Some types of systems must be available 24 hours a day, whether they are being used or not. The computer capacity dedicated to such systems cannot be used for other purposes. Thus, implementing a real-time system may require either purchase of a dedicated computer or an investment in additional computer capacity. In contrast, batch systems use computer capacity only when the program is being run. When the batch job completes processing, the free capacity can be reallocated to other applications for other operating purposes. The third and last characteristic difference is operational efficiency. Real-time processing in systems that handle large volumes of transactions each day can create operational inefficiencies. A single transaction may affect several different accounts. Some of these accounts, however, may not need to be updated in real time. In fact, the task of doing so takes time that, when multiplied by hundreds or thousands of transactions, can cause significant processing delays. But processing of non-critical accounts, however, improves operational efficiency by eliminating unnecessary activities at critical points in the process. This difference in operational efficiency will be highlighted later when we look at the hybrid process of batch processing with real-time processes. Efficiency versus effectiveness. In selecting a data processing mode, the designer must consider the trade-off between efficiency and effectiveness. For example, users of an airline reservation system cannot wait until 100 passengers, an efficient batch size, assemble in the travel agent's office before their transactions are processed. When immediate access to current information is critical to the user's needs, real-time processing is the logical choice. When time lags in information have no detrimental effects on the user's performance, and operational efficiencies can be achieved by processing data in batches, batch processing is probably the superior choice. Batch and real-time processing can both be used in a single process, as we shall see later in the revised version of our previous illustrative example of a simple sales order process. We first look at data structures.
Data structures influence the processing method the entity may adopt. Data structures constitute the physical and logical arrangements of data in files and databases. Understanding how data are organized and accessed is central to understanding transaction processing. Data structures have two fundamental components: organization and access method. Organization refers to the way records are physically arranged on the secondary storage device, for example, a disk. Secondary because the primary storage device is the memory, which is either one of the following: the read-only memory or ROM, the random access memory or RAM, the flash memory or the cache memory. These may be either of the general categories of sequential or random. The records in sequential files are stored in contiguous locations that occupy a specified area of disk space. Random files are stored without regard for their physical relationship to other records of the same file. In fact, random files may have records distributed throughout a disk. The access method is the technique used to locate records and to navigate through the database or file. No single structure is best for all processing tasks, and selecting a structure involves a trade-off between desirable features. The file operation requirements that influences the selection of the data structure are listed on the slide. These are the conceptual processes that should be allowed by any data structure, whether they are of the flat file or relational database model. Sequential file structures. Batch process using sequential file structures can be said as the most basic computer processing configuration. Under this configuration, for example, the record with primary key value 102 is placed in the physical storage space immediately following the record with primary key value 101 and before the record with primary key value 103. Thus, all records in the file lie in contiguous storage spaces in a specified sequence, ascending or descending order, arranged by their primary keys or P key. Sequential files are easy to process. The application starts at the beginning of the file and processes each record in sequence of the file processing operations listed in the preceding slide. This approach is efficient for operations 4 and 5, which are respectively reading an entire file and finding the next record in the file. Also, when a large portion of the file, perhaps 20% or more, is to be processed in one operation, the sequential structure is efficient for record updating, which is operation number 3. Sequential files are not efficient when the user is interested in locating only one or a few records on a file. A simple analogy can be made with an audio cassette player, such as the Walkman. If you wish to listen to only the 10th song on the feed, you must fast forward to that point at which you think the song is located and then press the play button. Some searching is usually required to find the beginning of the song. However, if you are interested in hearing all the songs on the tape, you can simply play it from the beginning. An example of sequential file application is payroll processing, whereby 100% of the employee records on the payroll file are processed each payroll period. The sequential access method does not permit accessing a record directly. Applications that require direct access operations, which are most applications nowadays, need a direct access structure, discussed in the following slide. Direct access structures. Direct access structures are stored at a unique location known as address on a storage device. The address is a numeric value that represents the cylinder, surface, and block location on the storage device. The operating system uses this address to store and retrieve the data record. Using our music analogy again, the direct access approach is similar to the way songs are stored on a music player, such as an iPod or an app that plays music downloaded on your smartphone, like YouTube Music, for example. If the listener chooses, he can select a specific song directly without searching through all the other songs, using primary keys like the song number and secondary keys like song title or the singer of the song. An important part of the direct access approach is in determining the DETI address, which is based on the record's primary key. Bank account numbers, social security numbers, credit card numbers, and license plate numbers are examples of primary keys that are translated into addresses to store and retrieve data by different business applications. Most of the later bases and techniques out in the modern technology universe today are classified as direct access.
Batch processing using sequential files. Now let's look back at our illustrative example of an entirely batch processed sales order process. Remember that a batch is a group of similar transactions that are accumulated over time and then processed together. The following highlight the advantages of the batch process. 1. Organization improve operational efficiency by grouping together large numbers of transactions into batches and processing them as a unit of work rather than processing each event separately. Economies are derived by making transaction batches as large as possible. Number 2, batch process provides control over the transaction process. The accuracy of the process is established by periodically reconciling the batch against the control figures. Balance should be sought between economic advantage of large batches and the troubleshooting disadvantage of large batches. Since finding an error in a very large batch may prove difficult, but it is easier in small batches. Assumptions and conditions in batch processing using sequential files. The logic of a sequential file update procedure is based on the following assumptions and conditions. 1. The transaction file contains fewer records than the master file. An organization may have thousands of customers listed in its customer accounts receivable file, but only a small percentage of these customers actually purchase goods during the period represented by the current batch of transactions. 2. More than one transaction record may correspond to a given master file record. For example, a department store sells its 50-inch television to several customers during a one-day sale. All of these transactions are separate records in the batch and must be processed against the same inventory master file record. Number 3, both transaction file and master file must be in the same sequential order. For purposes of our illustrative example, we will assume these to be ascending order. And number 4, the master file is presumed to be correct. Therefore, any sequencing irregularities are presumed to be errors in the transaction file, not in the master file, and will cause the update process to terminate abnormally. Keystroke. The first step in this simple sales order process is keystroke, which is represented by the general term input. In this example, the sales clerk transcribes source documents, the sales order form. Transcription is the process of converting written information into digital form. The transaction records created in this step contains data about customer sales. These data are used to update the appropriate customer and inventory records. As an internal control measure, the keystroke clerk calculates control totals for the batch based on the total sales amount and total number of inventory items sold, and inputs these control totals in the system. The system uses this information to maintain the integrity of the process. After each processing run, that is, the edit, sort, and update runs, control totals are recalculated and compared to the previously calculated value. Thus, if a record is incompletely processed, lost, or processed more than once, the batch totals calculated after the run will not equal the beginning batch totals. Once the system detects an out-of-balance condition, it sends error reports to users and data control personnel, and the processing of the transactions in the batch may be stopped or continued with errors depending on the threshold sets, such as the percentage of errors in a batch. Errors that did not proceed to update the master files are kept in a separate error or rejects file for investigation and pre-processing. The edit run at a predetermined times each day that data processing department executes this batch process. The edit program is the first to be run. This program identifies clerical errors in the batch and automatically removes these records from the transaction file. Error records go to a separate error file as already mentioned, and authorized personnel corrects and resubmits them for processing with the next batch. The edit program recalculates the batch total to reflect changes due to the removal of error records. The resulting clean transaction file then moves to the next program in the process, which is the sort runs. Before updating the sequential master file, the transaction file must be sorted and placed in the same sequence as the master file. Let's say the accounts receivable update comes first and the inventory comes next. The sales order file must first be sorted by account number. Execute the update run to update the account receivable master file, and then sorted by inventory number. Execute the update to run or update the inventory master file.
Notice that the record structure for the sales order file contains a primary key, or PK, a unique identifier, in this case the sales order number, and two secondary keys, SK fields, account number and inventory number. Account number is used to identify the customer account to be updated in the AR or accounts receivable master file. Inventory number is the key for locating the inventory record to be updated in the inventory master file. To simplify the example, we assume that each sale is for a single item of inventory. Because the accounts receivable update run comes first in the sequence, the sales order file must first be sorted by account number and then sorted by inventory number to update the accounts receivable master file first and then the inventory master file next. The update run. Updating a master file record involves changing the value of one or more of its variable fields to reflect the effects of a financial transaction. The system in our example performs two separate update procedures. The accounts receivable update program recalculates customer balances by adding the value stored in the invoice amount field of a transaction record to the current balance field value in the associated accounts receivable record. The inventory update program reduces inventory levels by deducting the quantity sold value of a transaction record from the quantity on hand field value of the associated inventory record. Notice that the update run creates the child version of the master files, and at the same time keeps the parent versions with the old values as backup. The update procedure in this example involves the following steps. 1. A sales record is read by the system. 2. Account number is used to search the accounts receivable master file and retrieve the corresponding accounts receivable record. 3. The accounts receivable update procedure calculates the new customer balance by adding the value stored in the invoice amount field of the sales order record to the current balance field value in the accounts receivable master record. Next, number 4, inventory number is used to search for the corresponding record in the inventory master file. And 5, the inventory update program reduces inventory levels by deducting the quantity sold in a transaction record from the quantity on hand field value in the inventory record. When these are done, a new sales order record is read, and the process is repeated until the program reaches the end of file and stops the process.
Batch processing using direct access files. Changing the file structure from sequential to direct access greatly simplifies the system. The shift to direct access files causes two noteworthy changes to the system. The first is the elimination of the sort programs. A disadvantage of sequential file updating is the need to sort the transaction file before each update runs. Sorting consumes a good deal of computer time and is error-prone when very large files are involved. Using direct access files eliminates the need to sort transactions into a predetermined sequence. The second change is the elimination of automatic file backup in the system. Direct Access Update does not produce a new physical master file as a byproduct of the process. Instead, changes to field values are made to the original physical file. Providing file backup requires separate procedures. Logic for Direct Access File Update. The figure on the next slide presents the general logic for updating direct access files. Notice that this logic is simpler than that used for sequential files. There are 3 reasons for this. First, because record sequencing is irrelevant, the logic does not need to consider the relationship between the transaction and master key values. Consequently, the update program does not need to deal explicitly with the problem of multiple transaction records for a given master record. Second, unprocessed master records are not copied to a new master file, saving time and other resources that otherwise would have been used by creating a copy of the master files. And third, complex procedures for searching the master file and retrieving the desired master records are performed by the computer operating system rather than by the update program. The program flowchart on the left of the slide represents the general logic for file update using the direct access method. The file representations on the right of the slide illustrate how the logic runs when 5 transaction records and 7 master file records. The transaction file is read from top to bottom. Each record is processed as it is encountered and without regard for its key sequence. First, transaction 7 is read into memory. The operating system then searches for and retrieves the corresponding record from the master file. The current record is updated in memory and immediately written back to its original location on the master file. Transaction records 2, 5, and 3 are all processed in the same manner. Finally, the second, transaction 7, is processed just as the first, resulting in master record 7 being updated twice. After transaction 7, there are no more transaction records in the loop, represented by the connector A in the program are stuck.
Batch processing using real-time data collection. A popular data processing approach, particularly for large operations, is to electronically capture transaction data at the source as they occur. By distributing data input capability to users, certain transaction errors can be prevented or detected and corrected at their source. The result is a transaction file that is free from most of the errors that plague older legacy systems. The transaction file is later processed in batch mode to achieve operational efficiency. This time, we will shift our example to our sales order process, such as that used in a department store or in online seller shops like Lazada and Shopee. Key steps in the process are: 1. The sales department clerk captures customer data, sales data, rather pertaining to the items being purchased and the customer's account. The system then checks the customer credit limit from data in their customer record. If it has the accounts receivables subsidiary file, if it has the credit detail or credit data, the credit limit data can also be retrieved from an external credit card company record accessible via internet access. And after retrieving the data, it updates his or her account balance or credit limit amount to reflect the amount of the transaction. Next, the system updates the quantity on hand field in the inventory record or the inventory subsidiary file to reflect the reduction in inventory because of the sale. This provides up-to-date information to other clerks as to inventory availability. And last, a record of the sale is then added to the sales order file, the transaction file, which is processed in batch mode at the end of the business day. This batch process records each transaction in the sales journal and updates the affected general ledger accounts. You may be wondering at this point why the sales journal and general ledger accounts are being processed in batch mode. Why not update them in real time along with the subsidiary accounts? The answer is to achieve operational efficiency, as we will now examine. Let's assume that the organization using the sales order system configuration in our example is a large organization such as a department store or a mall and capable of serving hundreds of customers concurrently. Also, assume that 500 sales terminals are distributed throughout its many large departments. Each customer sale affects the following 6 accounting records: One customer account receivable, which is a subsidiary master file, which is unique. And two, we have the inventory subsidiary master file, almost unique. And three, we have the inventory control, a general ledger master file, which is common to all transactions, and account receivable control file in the general ledger master file is also common. The sales account in the general ledger master file is also common, and the cost of goods sold account in the general ledger master file is also common. To maintain the integrity of accounting data once a record has been accessed for processing, it is locked by the system and made unavailable to other users until its processing is completed. Using the affected records noted here as an example, consider the implications that this data locking has on the users of the system. When processing a customer account receivable subsidiary record, the rule has no implication for other users of the system. Each user accesses only his or her unique record. For example, accessing one's account does not prevent Maria's account from being accessed by another sales clerk. Updating the inventory subsidiary record is almost unique because it is possible that both Juan and Maria are independently purchasing the same item at the same time, but at different branches of the organization. Maria may be kept waiting a few seconds until Juan's transaction releases the lock on the inventory account. This will be relatively rare event, and any such conflicts will be of little inconvenience to customers. As a general rule, therefore, master file records that are unique or almost unique to a transaction, such as customer accounts and individual records, can be updated in real time without causing operational delays. Updating the records in the general ledger is a different matter. All general ledger accounts previously listed need to be updated by every sales transaction. If the processing of Juan's transaction begins before that of Maria's, then Maria must wait until all 6 records have been updated before her transaction can proceed. However, the 20 or 30-second delay brought about by this conflict will probably not inconvenience Maria. This problem becomes manifest as transaction volumes increase. A 20-second delay in each of 500 customer transactions would create operational inefficiency on a chaotic level. Each of the 500 customers must wait until the person ahead of him or her in the queue has completed processing their transaction. The last person in the queue will experience a delay of 500 times 20 seconds, or equivalent to 2.75 hours, or 2 hours and 45 minutes. Therefore, it is more operationally efficient to process transactions that affect common records using the batch processed method. Real-time processing. Real-time systems process the entire transaction from input to file update as the transactions occur. For example, if all tasks in our simple sales order process is processed in real time from the capture of the sales order, filling of the order and shipping the same day, such a system has many potential benefits, including improved productivity, reduced inventory, increased inventory turnover, decreased logs in customer billing, and enhanced customer satisfaction. Because transaction information is transmitted electronically, physical source documents can be eliminated or greatly reduced. Real-time processing is well suited to systems that process lower transaction volumes and those that do not share common records. These systems make extensive use of local, wide, and even regional area network technologies. Terminals at distributed sites throughout the organization are used for receiving, processing, and sending information about current transactions. These must be linked in a network arrangement so users can communicate.
There it is, Chapter 3, Overview of the Transaction Processing Systems. In the subsequent chapters and lecture videos, different transaction cycles and their subsystems will be discussed, including the internal controls that ideally should be in place. We will start with the expenditure cycle. Thank you for listening and stay safe always.